It's bigger than the capacity of the next five biggest ports in Canada combined. But within the next decade, it's not going to be enough. And it's certainly not going to be enough if we're going to grow this economy, become stronger, more independent, more diversified, trade more with Asia and other parts of the world, which is what our intentions to do.
Canada just made a move that could change everything. A new plan is quietly opening a different path that may leave the US facing a big surprise. This could be much worse for the US than anyone expected. Prime Minister Mark Carney stood at Deltaport in British Columbia and made a promise. Canada will grow its exports away from the United States by more than 50%. Standing at the largest port in the country, he backed a $10 billion federal investment to expand it, creating 35,000 jobs and unlocking $100 billion in new annual trade capacity aimed squarely at Asia. As the tariff deadline nears, Carney is building the physical gateway to route Canada's economy around Washington. The announcement came at Global Container Terminal's Deltaport facility at Roberts Bank in Delta, British Columbia on July 30th, 2026, where Carney toured the site before laying out his support for the expansion. His argument started with the port's existing scale. When you look at the capacity of the Port of Vancouver, it's bigger than the capacity of the next five biggest ports in Canada combined, Carney said. But within the next decade, it's not going to be enough. That is the core of the gamble. Canada's largest port, already dominant, is being told it must grow dramatically to meet the country's diversification goals. The purpose Carney attached to the expansion was explicit about reducing American dependence. Canada must expand port capacity and connected infrastructure if the country is to become stronger, more independent, and more diversified, increasing trade with Asian countries while moving exports away from the United States. The federal government is looking to invest more than $10 billion to help expand the port, grow Canada's exports away from the United States by more than 50%, create over 18,000 jobs in construction, and another 17,000 full-time jobs in the operation of the additional capacity. That combined 35,000 jobs and the 50% export shift are the returns Carney is promising on the $10 billion commitment. The centerpiece of the strategy is the Roberts Bank Terminal 2 expansion, the most advanced part of the Port of Vancouver's broader gateway strategy. The project will expand the site into a three-berth container terminus. It promises to deliver 17,000 jobs to the region, increase the port's container capacity by 50%, and enable an additional $100 billion of new container trade annually. The preliminary cost estimate for the terminal itself is $3.5 billion, a figure that includes building an artificial island for the container expansion. The federal $10 billion figure supports the terminal and the connected infrastructure rail links, causeway widening, and the supporting systems that move goods from the terminal to the rest of the country. The scale of the physical construction is substantial. The Roberts Bank Terminal 2 contract includes delivery of an approximately 100-hectare marine landmass, a 35-hectare widened causeway, a 1,300-meter wharf structure and berth pocket, and an expanded tug basin. The Vancouver Fraser Port Authority issued its request for qualifications for the construction team in July 2025, selecting a progressive design-build procurement model with an independent fairness monitor appointed to oversee the process. Building an artificial island and a new deepwater container terminal is among the most complex marine infrastructure undertakings in Canada, the physical foundation on which the entire export diversification strategy rests. The commercial case connects the terminal directly to Canadian producers across the country. The Port Authority describes the three-berth container terminal as unlocking $100 billion of trade capacity annually and helping the Port of Vancouver move more of what Canadians make, mine, harvest, and grow. Port Authority CFO Victor Pang framed the terminal as a catalyst for economic transformation nationally, from supporting prairie grain exports and British Columbia's forestry sector to communities that depend on reliable access to goods. The terminal is projected to contribute $3 billion in GDP annually once operational. It is not a regional project, it is national trade, infrastructure, serving exporters from Saskatchewan wheat farmers to Ontario manufacturers seeking Asian buyers. The strategy fits within Carney's broader target of doubling Canada's exports to markets beyond the United States by 2035. The Delta Port expansion provides the physical capacity that Target requires, because a doubling of non-US exports is impossible without the port infrastructure to move that increased volume across the Pacific. The Strategic Exports Office launched the same week to coordinate international deal-making. The more than 20 trade and defense agreements signed over the past year, and the UAE and Ecuador deals concluded the previous Friday, all point toward Asia and Europe. The Roberts Bank expansion is the concrete infrastructure that turns those commercial agreements into physical trade flows. The referral to the Major Projects Office is the mechanism intended to accelerate the timeline. Federal Transport Minister Stephen McKinnon announced the referral of the Port of Vancouver Gateway Strategy to the Major Projects Office earlier in July. The federal government describes the strategy and its associated pillars, including Roberts Bank Terminal 2, as the type of nation-building infrastructure the Building Canada Act aims to urgently advance to diversify and grow trade capacity. The Major Projects Office is the same body reviewing the West Coast oil pipeline designed to compress the regulatory timelines that have historically delayed major Canadian infrastructure by years. Speed is part of the gamble, because the diversification the port enables only matters if it arrives before the trade pressures it addresses. The port strategy connects to the broader Roberts Bank story in a way that amplifies its significance. The proposed West Coast oil pipeline that Carney and Alberta Premier Danielle Smith announced on July 2nd would terminate at Roberts Bank, the same location as the container terminal expansion. The pipeline route would largely follow the existing Trans Mountain corridor before splintering off in the Fraser Valley to run alongside the US border before ending at Roberts Bank. That convergence makes Roberts Bank the single most strategically important export node in Canada, the terminus, for both the container trade heading to Asia and the oil exports heading to Pacific buyers. Carney was clear that the project must advance in partnership with Indigenous communities. We need to work in a way that is building inclusively with Indigenous partners, sharing in the economic benefits, ensuring that the incredible natural resources we have is not just preserved, but enhanced, he said. Roberts Bank Terminal 2 has already been through more than a decade of regulatory reviews and environmental assessment. It will continue to undergo consultation with Indigenous communities and environmental oversight as it moves through the Major Projects Office process, the balance between the acceleration the Building Canada Act enables and the consultation obligations that major projects carry. The gamble runs parallel to Carney's firm stance in the trade negotiations. Even as he builds the diversification infrastructure, the government has indicated it remains prepared to respond if new US tariffs are introduced. Carney has kept retaliation on the table as the August 19th tariff deadline approaches, combining the long-term diversification strategy with a firm negotiating posture. The port expansion is not a substitute for the negotiations. It is the structural insurance policy that reduces the leverage those negotiations carry, regardless of their outcome. The $10 billion figure represents one of the largest single federal infrastructure commitments in Canada's trade diversification push. It targets a 50% increase in exports away from the United States, 35,000 jobs, $100 billion in annual trade capacity, and $3 billion in annual GDP. The RBT2 terminal, the connected rail and causeway infrastructure, and the pipeline terminus converging at the same site make Roberts Bank the physical embodiment of Carney's entire strategy, a single stretch of the British Columbia coast being built into the gateway through which Canada intends to route its economic future toward Asia and away from the market that spent 2026 threatening it with tariffs.